Welcome again. Hope my audience are in good health indeed. Today I present you a new topic in banking and finance. It is very important because it poses a great threat to financial systems, especially in money laundering. It is also crucial in the banking world but often operates behind the scenes and the account is concentration accounts. You might have heard the concentration accounts called in other names like omnibus, settlement, or sweep accounts. But what exactly are they and why are they so important for banks and more critically for financial crime prevention? Let's break it down. Imagine a large bank with hundreds of branches and thousands of daily transactions. You have money coming in from private banking clients, trust accounts, international fund transfers, and more. Managing all these individual streams of money can be incredibly complex and inefficient. This is where concentration accounts come into play. Essentially, a concentration account is an internal bank account used to pool funds from many different sources into one centralized place. Think of it like a giant mixing bowl. The bank gathers funds from various customer transactions and locations throughout the day, puts them into this one concentration account, and then processes and settles them, usually within the same day. This aggregation makes processing transactions for things like private banking, trust, and custody services and international fund transfers much smoother and more efficient. It simplifies the bank's internal bookkeeping and helps manage liquidity. So, in short, they are a vital tool for the operational efficiency of a bank. But as with any powerful financial tool, there's a flip side. This very feature of pooling funds, which makes concentration accounts so useful, also makes them a target for money launderers. The primary risk is the potential loss of the audit trail. When funds from multiple customers are mixed together, there's a danger that the specific information identifying the customer, like their name, account number, and the exact transaction amount, could get separated from the actual movement of money. Let's visualize this. Imagine 10 different people pour their own uniquely colored water into a large container. Once mixed, it becomes incredibly difficult to separate the colors or even tell exactly how much water each person contributed just by looking at the final mixture. Similarly, if a bank isn't careful, illicit funds can be poured into a concentration account along with legitimate ones. Once mixed, if the identifying data is detached, it becomes nearly impossible to trace the origin of the dirty money. The financial transaction looks legitimate because it's coming from a bank's internal account, effectively masking the true source of the funds. This is a classic money laundering technique, making illicit funds appear as if they came from a legitimate source. The audit trail is the backbone of financial transparency and a key weapon against financial crime. Losing it means investigators can't follow the money, and criminals can move their ill-gotten gains with a lower risk of detection. This makes the proper management of concentration accounts a non-negotiable aspect of a bank's anti-money laundering or AML program. So, how do banks prevent this from happening? How do they use these accounts for efficiency without opening the door to financial crime? The answer lies in robust policies, strict procedures, and airtight internal controls. Regulators and financial crime experts have established a clear set of best practices that banks must follow. First and foremost, direct customer access to concentration accounts is strictly prohibited. You, as a customer, should never even know that a concentration account exists, let alone be able to instruct a bank employee to move your money through one. All your transactions should be clearly and accurately reflected on your own personal or business account statements. This is fundamental. The concentration account is purely an internal operational tool for the bank, not a transactional account for customers. To maintain integrity, banks implement several key controls. One common practice is requiring dual signatures on any general ledger tickets related to these accounts. This means that at least two authorized individuals must sign off on movements, creating a system of checks and balances and preventing any single person from manipulating the account. Another critical control is retaining all the necessary information. Even though funds are being aggregated, the bank must have systems in place to ensure that all the original customer and transaction identifying data is captured and linked to the funds moving through the concentration account. This means the who, what, where, when, and how much of every single transaction that flows into the pool is meticulously recorded and maintained. This preserves the all-important audit trail. Furthermore, frequent reconciliation is a must, and this task can't be done by just anyone. It needs to be performed by an individual or department that is completely independent of the people conducting the transactions. This independent oversight ensures that all funds are accounted for and that the account is balancing correctly. If there are any discrepancies, a timely resolution process must be in place to investigate and fix them immediately. Small discrepancies can sometimes be an early warning sign of bigger problems or even fraudulent activity. Finally, proactive monitoring is key. Banks use sophisticated monitoring systems to keep an eye on the activity within these accounts. This includes identifying and monitoring recurring customer names whose transactions frequently pass through the concentration account system. While this can be normal for certain types of business, unusual patterns or high-frequency movements could be a red flag that warrants further investigation. By identifying these patterns, the bank's compliance team can take a closer look to ensure everything is legitimate. By implementing these controls prohibiting customer access, requiring dual signatures, capturing all transaction data, conducting independent reconciliations, and continuously monitoring for suspicious activity, banks can effectively mitigate the money laundering risks associated with concentration accounts. They can leverage the operational benefits without compromising their integrity or their role in fighting financial crime. In conclusion, concentration accounts are a powerful and necessary tool for modern banking, enabling efficiency and streamlined operations. However, their nature of commingling funds presents a significant money laundering risk if not managed with extreme care. Strong internal controls are not just best practice, they are an absolute necessity to ensure that these accounts are used for their intended purpose and not exploited by those looking to hide and move illicit funds. It is a perfect example of how the nitty-gritty operational details of banking are directly linked to the global fight against financial crime. Thank you so much for joining me today to explore the world of concentration accounts. I hope this explanation was clear and helpful. If you found this video insightful, please give it a thumbs up and don't forget to subscribe to the channel for more deep dives into the fascinating world of finance and financial crime prevention. Hit that notification bell so you won't miss our next video. As always, if you have any questions, drop them in the comments below. See you next time with new topic. Thank you for watching or listening in patience indeed.